The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Welcome to Squawk Box Europe. I'm Karen Cho with Ben Boulos. These are your headlines. Another Nvidia earnings release, another beat. The chip giant projects 70% sales growth next year and downplays circular financing fears. CEO Jensen Huang outlines the demand picture to CNBC.
Obviously, we're already a very large company, but to be able to grow continuously and now to accelerate our growth is pretty extraordinary. Now, what's happening underneath, the things that are going on, number one, is that AI is now useful. It's doing productive work.
AI deal-making continues as sources tell CNBC. Anthropic has struck a $45 billion cloud deal with Nscale, and reports say Nvidia could buy Hugging Face just weeks after its OpenAI breach.
All eyes on Fed Chair Warsh as central bankers converge on Jackson Hole amid bond market turmoil as PCE inflation comes in slightly hotter than expected.
Nvidia delivering another bumper set of financial results and boosting its sales forecast. The world's most valuable company now projecting 70% sales growth next year after revenue more than doubled in the second quarter to $76.2 billion. That projection, along with the announcement that Amazon Web Services will start deploying additional 2 million of its GPUs this quarter, pushed the shares up more than 4% in extended trade. Nvidia CEO Jensen Huang spoke to CNBC's Jim Cramer about some of the key drivers behind the relentless demand for its AI chips.
It's not easy, but let's say, first of all, demand is super strong and incredibly, it's accelerating. You know, obviously, we're already a very large company, but to be able to grow continuously and now to accelerate our growth is pretty extraordinary. Now, what's happening underneath, the things that are going on, number one, is that AI is now useful. It's doing productive work. And the tokens that are being generated by these AI labs are now profitable. People are paying good money to use it because it's really productive. It's helping them, do things and be more productive. And so the amount of tokens they want to generate is increasing because of use. The amount of tokens they're generating is increasing because the AI models are more complicated. And then now, because it's profitable, they have so many more customers who want to use it. The thing that's holding them back is compute. And so that's literally one pillar of what's happening in our business. And then after that, we're seeing AI being adopted all over the world. Every single country wants to get involved. Every company wants to get involved. And so half of our business is in the hyperscalers, and the other half of our business is everything else. It's neo clouds and sovereign clouds and enterprise companies. And all of this is all growing at the same time. And this is all happening, of course, at a time when we're rolling out Vera Rubin, our next generation product. It's going to be the fastest ramping product in our history. It's really exciting.
Nvidia CFO Colette Kress has pushed back on claims that the chipmaker's billion-dollar investments and financing deals with other AI companies on data center projects were part of a circular financing strategy. Speaking on the company's earnings call, Kress said she believed risk was limited and equity returns on Nvidia's invested capital will be, quote, excellent. Arjun joins us with plenty more on the Nvidia numbers. Arjun, I want to get into the weeds on this. It felt as though the market was just looking forward and wanted to see the guidance and the fact that it had 70% of revenue predicted for 2028. That was just music to the ears of investors, so nervous about the demand story fading.
Yeah, when we were talking about this story yesterday, I said guidance was going to be key. And what was interesting is they guided a year out. This is an incredibly unusual move for Nvidia at this point in time. Even Jensen Huang said this is not something we normally do, but he said that we've got enough visibility into the upstream and downstream, i.e. the supply chain, their customers, to make that confidently. But he also said that was a scenario where they continued to be supply constrained and that demand actually is exceeding that. So if they were able to actually meet the demand, that growth would be higher. And that was certainly, as you said, music to the ears of the market, which have been very nervous about this AI story about whether this demand is real and whether this sort of strong capex and growth that is being seen, particularly at the chip companies, can continue as well. And there were some other interesting parts, I think, that were also very key to making investors feel a bit more reassured. One was the diversification story, and Nvidia saying that in the quarter, Nvidia's AI clouds, industrial and enterprise customers, this is everyone except the hyperscalers, saw around 138% growth. So they're now nearly at sort of 50-50 in terms of that revenue split, which is a big important story. And finally, Vera Rubin. This is the next generation platform. We heard a lot more about that this is the fastest production ramp in the history of Nvidia, and they're already getting orders, and they're expecting about 20% of the data center revenue in the current quarter to come from Vera Rubin, which is, again, was a big positive because the market wanted to hear that this next generation product was getting some traction as well.
Yep, a number of price target increases at the likes of JP Morgan, now to 320. You had RBC raising its target price to 330. So the broker community has responded. One of the fears, though, has been the circular financing. It was interesting to hear the CFO talk about this and how she sees frontier labs like OpenAI calling it to become the largest technology companies in history. So almost trying to silence the fears that everybody's putting all their chips in the same direction.
Yeah, I mean, what was interesting is their net income for the quarter included a $7.8 billion gain on some of these investments. So it's becoming, and you mentioned it yesterday actually, Karen, it's becoming a story now that it's not just about obviously Nvidia selling these chips, but actually, the gains they're seeing from some of these investments. That carries risk. It's SoftBank-esque to some extent, but that brings its own risks, of course, because we've seen with SoftBank the fluctuations in valuations and what that can do to the company's quarterly earnings as well. But I think for Nvidia, there's two ways to look at it. One, that of course this brings in enormous risk when, Nvidia, to some extent, many are seeing him as this sort of central bank-like figure, this backstop to the community. But also there is a sense here that actually Nvidia is allowing new customers to access its chips, customers who ordinarily would not have been able to afford or been able to get into this infrastructure play. And that's why this $500 billion financing package announced very recently with all those institutions becomes very interesting, because now they can go to market to a customer who says, well, I haven't got hundreds of billions to spend like the hyperscalers. And Nvidia can say, well, we've got this neat little financing package you want to tap into, and you can buy some GPUs. And I think that's very interesting as well, because it bears a lot of risk to some extent, but also it's not just Nvidia's risk here, and it opens potentially some new customers as it looks to diversify beyond just the hyperscaler community.
Oh, it's fascinating, isn't it, when they've reported their revenues doubling in the quarter compared to a year earlier, and the finance chief saying, implying perhaps that their guidance could have been even higher for the coming year were it not for the supply constraints around memory chips, saying, customer forecasts point to our growth doubling next year. However, we are supply constrained. So their growth could have been even more were it not for this memory chip shortage.
Yeah, there were a lot of the discussion on the earnings call was about the supply chain, actually, and it was about memory, which we know is in very short supply. TSMC can only manufacture a certain number of chips, and Nvidia is not its only customer as well. Remember that. So, that brings another supply constraint as well. This is all very good news, by the way, for Nvidia. This is all fantastic news. It gives them incredible pricing power. Their margins were north of 70% again, and they said their margins are going to bottom in this current quarter, as they deal with this memory issue. So this is all fantastic news for Nvidia because, one, it gives them a longer tail of growth, but two, it gives them incredibly strong pricing power in the market, and they will be at the likes of SK Hynix and Samsung and elsewhere at TSMC. They will be amongst the top customers in the pecking order when it comes to allocating production. So that's good news for them to some extent. They were saying that these supply constraints are going to continue into fiscal year 2028 through to next year potentially as well, which is very interesting. And finally, that forecast also includes zero China. So that is still a market very much shut off to Nvidia. I think less than 1% of their data center sales came from China in the last quarter. So again, they are seeing a lot of growth even without all of these other aspects, which could see that growth be even higher, according to their executives.
The optics around trade don't look any better this week when we talk about China. Thank you very much for that, Arj. Sidi Job joins us now, fund manager, Econopolis Exponential Technologies Funds. Sidi, thank you very much for joining us today. Let me ask you just first up what you thought of Nvidia, because it feels like it's very hard to take away from what is a very glossy report card overnight.
Good morning, Karen. Good morning, Ben. Well, the results of Nvidia, I guess if we just take the Q2 results and the guides, probably I would have been a bit less bullish, in particular because the Q3 figure was above consensus, above the or in line with the whisper number, but to some extent did flag a deceleration of the top line growth versus the reported Q2 figure. And also the 74% margin guidance for the third quarter was a notch below what you would have hoped for. Now, that was before the conference call started, because actually that's where the magic happened. First of all, as you already discussed, the guidance for fiscal year 2028 of 70%, which is actually 20% above consensus, which means that after Q3, we will see a re-acceleration of growth. And the company explained that this was largely because of the hyperscalers, which probably will see a bit of softer growth in the third quarter as Blackwell is leveling off and Vera Rubin is picking up. But that should then again re-accelerate in the fourth quarter. So that was definitely the twisting point in the equity story yesterday evening. Also, to underscore the strength of the guidance for 2028, Colette, the CFO of Nvidia, she mentioned that this year a hyperscaler capex would be around 800 billion, and that next year that figure should go to 1.3 trillion. Now, the street consensus for capex for next year is 1 trillion, which means that it's also a very positive signal for the entire AI infrastructure ecosystem, because capex of the hyperscalers will go up again next year quite significantly.
Sidi, let me ask you about the equity investments. We're just talking about this. I've been describing it as SoftBank-esque. I'm not sure whether you agree with that, but 99 billion in equity investments, commitments for another 25 billion more. How do you view these bets as Nvidia tries to morph into something quite different from just being a chip company?
Well, I wouldn't call them a bet, because with a bet you have normally 50% chance you win, 50% you lose. In this case, Nvidia is the one that is driving the revenues of those suppliers. They have a very good visibility now into what they will be buying from them. And as such, they have a higher chance of making a return on their buck for those companies. It's also a way of fluidifying the supply chain. They have made around 280 billion of supply contracts with their suppliers to basically provide them with the visibility they need to increase their capacity. So if you tie those two together, I think it's a very sane move from them to do so. And the impact on the bottom line of those investments will not be material enough. I think the core business of Nvidia, if we pull through the 70% that they guided for 2028, and then take some prudent assumptions for 2029, then this will become a $1 trillion revenue company by 2029, 2030, and with 55% net margins, it means that they will have more than 500 billion in net results over the coming in 2 years from now. So that is definitely the key story here.
Sidi, for anyone listening to this latest update from Nvidia, thinking, oh, could well do with a piece of that in my portfolio. Is it too late? Do you think the boat has sailed in terms of riding that wave, or do you think there is still a potential entry point?
Well, I'm a fundamental guy, so what I try to do is look at the figures, and for me, the figures speak for themselves. Again, if you make a valuation based on the traditional DCF, or you use multiples and you use multiples on a forward basis, basically they all tell you that the valuation today is cheap. If we take the next year PE multiple, then we will end up around 14 times forward PE. For a company of this magnitude, with this kind of visibility in terms of earnings profile, So for me, it basically means that there is plenty of upside in the Nvidia share.
Why do you think their shares haven't surged more? Because actually, I think on a year-to-date basis, Nvidia stock it's done well. It's gone in line with the broader S&P 500, but I think it's underperformed the broader semiconductor ETFs.
Well, you're correct in that observation. Let me first come out with an analogy. In the past, when map makers were drawing their maps, they would be drawing sea monsters on the places where they've not been. It's not because they were sea monsters, it's because they didn't know what was coming. And I guess that's the same with AI. What we now see is indeed unprecedented in terms of the size of the business, in terms of the capex, in terms of the cash flow generation, and I clearly understand that on itself brings a bit of fear to the market. I guess that reflects in consensus forecasts where you have a wide dispersion in the forecast, in particular for 2028, 2029. And I guess that's also part of the reason why Jensen was this frankly with putting out this guidance, is to basically align all heads in the same direction. That'll be true for investors, but also for Nvidia's clients, Nvidia's suppliers. This is an important message that we have a North Star. And that'll be the trigger to basically remove the undervaluation that we've recently had. A second element is that if we look back in the last couple of quarters, it is true that a number of other semiconductor companies which hadn't risen that strong previously and that are also experiencing the same bottlenecks triggered by the rollout of AI, they drew a bit more attention. Let's look at the memory players, but also companies in the Photonica complex, companies like Lumentum, Coherent, Applied Optoelectronics. Right. All those players, they basically are riding the same wave and had not yet re-rated that strongly.
Sidi, these are also companies that Nvidia has invested in. Let me ask you about the other one. We're talking about Hugging Face today. Nvidia had invested very early on, 2023, in a Series D funding round for Hugging Face. It is now obviously looking to go all in as this deal progresses towards a $13 billion transaction. The company and the merits here, some are saying, look, this is a company that's at the intersection of AI. It's a platform you build in. It feels as though Nvidia is trying to put itself at every roundabout, every intersection to make sure it doesn't miss out on any of the AI trends. Does it make sense for Nvidia to go after Hugging Face with a $13 billion valuation?
I do think so for a couple of reasons. First of all, I do see Hugging Face within the ecosystem or the debate around closed models versus open source models. Hugging Face is the platform to deploy the open source models, and Nvidia made clear that they are not choosing between one and the other. They think that both can live together, and that they are needed to develop AI and to widen the dispersion of AI. Also, I think Nvidia is very much a community, a platform-based company, and in that respect, I think Hugging Face fits perfectly within that. There is this five-layer cake from Nvidia, and foundational models are one of them. And it is clearly that Nvidia wants to be integrated in the entire stack vertically, going from energy to foundational models and also to applications.
Okay, Sidi, really good to get your thoughts. Thank you very much for joining us this morning. Sidi Job, Fund Manager at Econopolis Exponential Technologies Funds. Nvidia is reportedly nearing a deal to buy Hugging Face, as we were just discussing. It would value the AI startup at nearly $13 billion. This is according to multiple media reports. Business Insider says the two sides have held serious conversations about a possible agreement in recent weeks. Meanwhile, a separate report from The Information, citing a person familiar with the matter, said that two companies have already closed the deal. Hugging Face has recently been in the news after it was revealed that OpenAI's rogue AI agent briefly hacked the platform. Anthropic has struck a cloud contract with UK-based Nscale worth around $45 billion. This is according to CNBC sources confirming earlier reports. The Claude creator will rent around 460 megawatts of compute capacity at an Nscale data center development in West Virginia. Anthropic will also leverage Nvidia's advanced Vera Rubin chips through the facility, which is due to come online at the end of 2027. Salesforce and Anthropic are expanding their strategic partnership, unveiling a plugin they have dubbed Claude Force that will enable salespeople to access critical data directly from inside Anthropic's Claude chatbot. The companies say they plan to introduce more integrations across Claude, Salesforce and its messaging platform Slack in the future. Now, while you're watching, you may be doom scrolling on your phone, but could there be an end to that? Is there a social reckoning? Meta forks out billions to settle its blockbuster legal battle over child safety and pledges major changes to its platform. That's coming up after the break. Also, drinks giant Pernod Ricard disappoints in its full-year sales figure. We'll find out why. And Belgian insurer Ageas sees first-half profits rise despite an adverse weather impact. We'll be speaking to the CEO in just a few moments.
Executive Decisions is the new podcast from CNBC, where I ask powerful leaders about their decisions that changed everything. I'm Steve Sedgwick. Here's the CEO of the London Stock Exchange Group, Julia Hoggett.
There is no justification whatsoever for not doing the right thing, even if the right thing is hard to do. Which also means that if the context changes or the information changes, it is absolutely fine to also change your mind.
That's Executive Decisions with me, Steve Sedgwick. Get it wherever you're listening to this.
Belgium-based insurer Ageas has reported a first-half net operating result of €776 million. That's a 6% increase on last year. The firm flagged the impact of adverse weather, particularly in Belgium and Portugal, which weighed on its non-life division. Hans de Kuiper is the CEO of Ageas and joins us now. Very good to have you with us. Just talk us through these latest figures and the impact that you mentioned there about the adverse weather and how that's affected them.
Sure, thank you and good morning for having me on the show. Well, first of all, we have shown a very clear commercial momentum. Our inflows around the world are up 17% year on year, and that's also resulting, I think, in a strong improvement of the net operating results, up 6%. Indeed, we are more impacted by weather this year than last year, and weather weighs for approximately 180 million euros on our results, and that's approximately 5% of the claims ratio. And if I put that in perspective, last year it was around 35 million and only 1%. And this is due to, of course, the bad weather in January and February in the Portuguese market, which was a combination of hail with heavy winds, and then the more frequent, smaller events in Belgium in the springtime.
Do you think you may be forced to increase your premiums for customers in light of these increased payouts that you've faced because of the weather?
Well, that depends heavily from country to country. But if I look at Belgium and also to some extent at Portugal, over the years we see the attritional losses and the claims frequency slowing coming down, and that is because of better prevention, that is because of connected homes, that is because of autonomous systems in cars. And we have seen that until now, actually, the impact on premium rises have been quite moderate in the Belgium and the Portuguese market, as it is absorbed by, I would say, the rest of the risks and the business in home and in motor. The UK market, I would say, is slightly different. It's a highly price competitive market. First half year, qua weather was quite okay in the UK, but you see that subsidence with this summer weather is coming in towards the second half of the year. And there, I would say the premium rates are more sensitive to the evolution in the weather risk.
Hans, I was just going to ask you about that, because if we look at the non-life portfolio, the underlying performance was described as healthy if you strip out the weather effects. Are premiums the only way to manage climate change from here, or is there a broader approach? Because it felt as though insurance companies, from pulling back de-risking in recent years, had now looked to manage the portfolio and still be present for customers in future.
Indeed, I think we, of course, have to manage on our risks, but at the same time, I think we have also the social duty to provide cover to societies on this changing climate. The strategy that we are following is a strategy of diversification. We have important direct businesses in the UK, in Belgium, in Portugal. But we have also started 3 years ago a global reinsurance activity. And so what we do is we try to diversify that weather risk globally, to make sure that we are well represented in all regions, because luckily weather events are still very local events. So you can see that in the comparison for us this year compared to last year. So to make sure we can stay in the markets, that we can keep peace of mind for our customers, we diversify globally. That being said, for the very big events, I would say public-private partnerships are also important. There should be a limitation to also protect the insurance industry for these mass events. And there you see multiple countries developing public-private partnerships where the sector takes a big part, I would say, of the main risk, but the very big events, they can count on some support by national or supranational institutions.
And let me ask you about the bulking up in the UK over the past year, the purchase of eShore from Bain Capital. This environment feels as though there's a lot of competition still when it comes to the UK insurance market. I mean, how would you describe the competitive landscape out there?
Yeah, the competitors' landscape is intense. We have seen the market continue to soften in the first half of the year. My impression is that the motor market has taken a turn. And we also see that over the summer, where claims frequency in the UK has gone up. We have seen the market moving, I would say, mid-single digit. We have done a little bit more there in adjusting the premium wage. The household market, I would say, is still in a very soft market. And there I'm curious to see what's going to happen in the second half of the year, also after this very dry and sunny weather. The great advantage for us with the acquisition of eShore and also the business from Saga is that we are now very diversified qua distribution channels and also by customer groups. And that gives us a lot more flexibility, agility, I would say, to position ourselves in this very competitive market, as we have different channels to reach the different customer groups. So I'm confident on the quality of our business, our underlying performance, but the market is still in a soft mode today.
Hans, from acquisitions to divestments, and it looks as if earlier this month you have a buyer for the remaining stake in Etika, the Asian-based business. As I understand it, the proceeds from that will amount to around €1 billion. Just explain the strategy behind that divestment and what you plan to do with the money that you now have from that sale. How do you plan to deploy it?
Yeah. Well, first of all, indeed, this is the first, actually, the oldest joint venture when we went into Asia 25 years ago. Our partner in that country, Maybank, actually approached us to take back their stake in the insurance group for what was for us a very attractive valuation. And that's why I think we entered into the sales process of our Malaysian business. That being said, Asia remains a very attractive region for us. We are in the first place a life insurance player and pension player in that market. And it's clear that aging population is a very actual theme globally, but definitely also very much in the Asian region. So we are definitely staying in that region. And if we see opportunities also with our partners to widen our participation in those markets, these are definitely opportunities that we will look into. With the proceeds, we closed this half year with a bit more than 1 billion, I would say, on the bank account. We will get a bit more than 1 billion from the Malaysian transaction once it is closed. So that gives us, I would say, some firepower without debt of 2 billion. Our strategy is a sustainable growth strategy, both in Europe, in Asia, and in reinsurance. And so that's also the first direction we would look to invest in the markets where we are, or to explore new opportunities if they would arise. If not, of course, then we will look at the shareholder. We are already announcing a 1.5 euro interim dividend today. And of course, if we have excess cash without opportunities, then we can always look at a share buyback opportunity.